Devesh already mentioned, but just to recap, who are we? We are a digital lending platform. If you ask us, we go by the brand name Kissht. Kissht is installment in Hindi. If I were to just put it in simple terms, what have we developed over the last 8 years? We have created a platform that makes it easy for the customers to come, go through a journey. That journey may take anywhere from 5 to 10 minutes. And in that journey, in a very simple, dignified manner, they are able to share information. We are able to gather additional information about the customer. And at the end of the journey, we are able to make a very prudent call on whether the customer is credit worthy or not. And if he is credit worthy, we are able to disburse the loan on the spot. And this platform has therefore created a convenience proposition which has enabled us to be at a place, as I will talk later, to have 11 million unique followers we have served today. I'll go in detail, but if I were to say, as I say, lending, giving money is easy. If you ask us the two important fulcrums on the back of which we have been successful, the first one is risk management. We are a lending company. Ultimately, risk management decides success or failure. And I'll talk about how our tech-driven, machine learning-based proprietary underwriting models, back to automated triggers, and a very, very strong focus on collections on the back of automated collection system has helped us manage risk through the cycle for the last 8 years. Also, to talk about a little bit about our acquisition strategy. We are a company which has a very diverse acquisition strategy, multiple acquisition channels, and with every passing, I would say, months and years, the brand recall of Kissht is increasing, which helps us, increase the organic acquisition, which, as you may recall, will ultimately lower the acquisition cost and make the unit economics far more resilient for the sake of the company. We are back. I think the last thing I would say at the bottom, we have a very balanced liability strategy. We have our own NBFC, which funds 50% of the loans, and the remaining 50% of the loans is what we call as off-balance sheet, where we partner with larger NBFCs and banks to make the loans for our customers, and I'll talk more about it. Spending a few minutes on the opportunity, I think this is something that all of us are aware. Everybody talks about the India opportunity. As repetitive as it may sound, the reality is that our core target market, which is the mass market segment, is the market which is really questioning in India. As you will see in the RHP, in the industry report, this is a segment that will go from 31% of the population at a household level to 37%. And from a credit outstanding opportunity, it represents a 19% CAGR over the next 5 years. Now, while that is the overall credit opportunity we are talking about, if I drill down into the specific sub-opportunity that Kissht is going after, which is a digital lending opportunity, the opportunity is even bigger. While the retail credit opportunity is growing at 19%, for the two products that we offer, which is a personal loan as well as a loan against property, they are growing at 24%, and within that, if I look at the digital lending opportunity, that itself is growing at 48%. So we are talking about a segment where we are able to execute well, continue to be prudent in the way you underwrite. It represents a great growth opportunity over the next 5 to 7 years. And ultimately, if I look at the challenges the segment faces, it's about the traditional approach has been far more rigid. The product constructs are one size fits all. Very, very tedious processes, multiple visits to branches, speaking to relationship managers, etc., and ultimately leading to a very, very poor experience for the borrower. This is an overview of where we are today. As I mentioned, as of December 2025, we have served 11.17 million unique borrowers. These are people we have given money to. These are not just people who have downloaded our app or have gotten a sanction. These are actually people we have disbursed money to. On the back of these borrowers, as we speak, or rather in December, our AUM was 5956 crores. In this 5956 crores, 50% of the contribution comes from repeat customers. It is an important facet because ultimately customer acquisition being very important, managing the customer delight, the customer experience, and ensuring that the customer comes back and remains with you creates a very important value driver for the company and ultimately for the franchise health. We are a company which has a very healthy capital adequacy ratio of 26.69%. And we've been a company that has been consistently profitable as given in the prospectus. For the 9-month fiscal year 26, we have delivered a profit of 199 crores, which translates to a 5.29% return on average AUM and a 23.51% return on average equity, which I would like to believe is significantly above market average. All of this profitability is on the back of very healthy risk metrics. So our GNPA is at 2.9%, and given our high provision coverage ratio, our net NPA is at 0.38%. This is a quick overview of the segment we cater to. From a profession standpoint, if you actually take a look, it's a very diverse segment base. 48% of our customers are salaried, whereas 52% of our customers are self-employed small business owners. From an income band perspective, maximum customers are between 25,000 monthly income to about 1 lakh income, with a fair degree of customers who are greater than 1 lakh as well. About 12% of the customers who are greater than 1 lakh per month income as well. We are a company that are slightly more concentrated on the urban sector. I think when we talk about it, we have a very digital way of acquiring customers, so our customers are typically very digitally savvy. And because there is a reliance on steady income stream, there is some correlation between segments in the urban versus the semi-urban and rural areas. But with every passing time, the opportunity in semi-urban and rural are only growing, which is actually giving us a larger list of opportunity to cater to. But as we speak, top 50 centers contribute to 64% of our total business. Our function of being digitally savvy, a large percentage of our customers are young. So 73.5% of our customers are below the age of 35, and the average age of our customer is 32 years of age. I think the last thing about our segment, given it's a mass market segment, there is sometimes this tendency to feel that it's a as I call it, a subprime segment, or maybe not that creditworthy. But if you actually look at the average CIBIL score for our customers, it is 746, which is a very healthy CIBIL score. This is just to reiterate that income typically is not just the only reflector of credit quality. There are other means you can look at, and 746 is a good reflection of that. Just a quick recap, we offer two products in the market. One is the unsecured personal loan. We give it up to 5 years and ticket size up to 5 lakhs. This is the product we launched in 2016 when we started our journey, and have been doing it for the last 8 to 9 years. Loan against property is a secured product. This is a more recent product we launched close to 2 years back. It constitutes 5.8% of our overall business as of December. This is a product where we basically offer loans up to 15 years and up to 30 lakhs. I think across both the personal loan and the LAP product, if I take a customer view, the real proposition we give to the customer is convenience, dignified process, and a very fast turnaround time. While I think turnaround time for a personal loan for a new customer is on an average 7 to 10 minutes, for a LAP, our turnaround time, as you see here, for 84% of our customers is less than 15 days. Some of you may be well aware with loan against property product, and you will realize that the 15-day turnaround for 84% of our customers is actually significantly better than what the market would offer. Coming to acquisition, what you see actually on the India map is a dispersal of all of the customers we have served till date. So, I think the map is self-evidently. Given the digital nature of our infrastructure, we are actually not bound by any specific geography. We cater to the entire market, as long as we can identify a creditworthy customer through the digital journey. For new customers, we have 4 channels through which we acquire customers. 45% of our acquisition happens from digital marketing. This is basically putting your ads in digital platforms such as Facebook, Google, and other such affiliates. Another 31% comes through partnership with merchants. 24%, close to 24% comes through offline merchants. These are small merchants. We call it QR-led acquisition, where these small merchants are able to convert their walk-in customers into Kissht customers. And then 7 to 8% of that acquisition comes through partnership with larger e-commerce players. where we basically partner with them and try to acquire customers who may come on their platform to become Kissht customers. I think very importantly, the organic channel. These are people for whom, by definition, they are people for whom we don't pay any affiliate any money, right? So the cap for these customers are zero. They constitute 23.7% of our total acquisition. This is an important metric for two reasons. I think reason number one, very mathematically speaking, it reduces CAC and therefore enables greater franchise value. But more importantly, it's a true reflection of the brand recall, right? These are people who either through word of mouth or through recommendation basically chose Kissht rather than we reaching out to them and doing it. So a healthy number of 23%, which if you compare, when we had launched the DRHP, which is basically the March number, the same percentage was 90, and the RHP, which is basically the December number, which is just 9 months later, is at 23%. So I mean the trend would be evidently. I think the growth in the organic share in those 9 months is a reflection of the improving brand. Of course, it is also a reflection that very recently, about 18 months back, we onboarded Mr. Sachin Tendulkar as our brand ambassador, and someone with that kind of credibility has helped us improve our own image as a fintech company, but as a credible fintech company. Talking about underwriting, see, this is at one level. If you ask us why we are being successful, see, we are in the mass market space, we are in the unsecured personal lending space. People always talk about this is a segment and a product that goes through business cycles. But if you were to look at our historical journey, not that we are being impervious to these market cycles, but we have been far more steady in our delivery of performance. And I think one of the big reasons for that is the entire technology and data-driven approach to underwriting. The underwriting model we talk about, which uses advanced machine learning and AI tools, looks at numerous data variables, right? I'm talking about 400 plus credit and fraud variables, 200 plus figures, backed by 42 data scientists of the highest quality who help us underwrite, but more than underwrite, also monitor on a very, very constant basis, making our organization very, very agile to these market sectors. On top of the underwriting, there are system-based triggers. See, given that we don't have branches, at least for our personal loan business, some of these triggers helps us monitor the health of not only the quality of our own business, but also the quality of the macro. So these triggers automatically, on a very continuous basis, suggest what are the alterations we need to make. These are not triggers where I find out that the risk is deteriorating. These are triggers which are actually advanced for me, which almost tells us what is it that could happen. And the building of these triggers as a core part of our platform helps us predict and be agile to some changing market conditions, which may otherwise be a little too late in terms of reacting. Now, while one into maybe a prudent way to manage risk at the point of entry, I think the part 3 is the automated collection system. It is something we have developed in-house from day one. We believe it's an important facet of the value chain. We have developed this automated collection system from two perspectives. Of course, to maximize collection efficiency, but also to have a very strong monitoring control over the entire process. This is one area where if not done correctly, there are reputational risks, there are customer risks in terms of malpractices and other activities that could go on. Therefore, the automated collection system has helped on the business side, but also to some extent on just managing collections in a way which is healthy and has a human touch. These are just some numbers I wanted to share compared to some of the peers in the market. Our GNP I already talked about is 2.9%. We have compared to a few of the peers in the listed space who have a healthy mix of unsecured business. As you know, all of the leading lenders that have multiple products. But if you compare our GNPA, it is at par with all of them. And because we follow a very, very high provision coverage ratio of 86.88%, our net NPA of 0.38% is one of the best in class. Just want to talk a little bit about the liability strategy that we have. As we mentioned, end of December, our AUM was 5956 crores. This 5956 crores of loan AUM has been supported by on-balance sheet. So from a corporate structure standpoint, We have one in OnEMI Technology Solutions Limited, which is the company going for listing. We have a 100% subsidiary called Capital Services, which is an RBI registered NBFC. So 49%, sorry, 51%, correct myself, 51% of the lending has happened through the NBFC arm, which is a subsidiary of the company, and 49% of the lending has happened through partnerships with other NBFCs and banks. Talking about the on-book lending, we have a mix of 47 lenders, a very, very diversified field. These 47 lenders are many other banks, many other NBFCs and other reputed institutions who have subscribed to our NCDs. On the off-balance sheet side, again, very diverse group, multiple such arrangements. If I can just take 2 minutes to explain, the way this off-balance sheet works is that we originate the loan on behalf of the partner. We give the partner what is called as a 5% FLDG, first loss default guarantee. So our exposure in terms of risk to this book is up to an extent of 5%, and any loss, if it were to occur which is greater than 5%, the exposure will go to the partner. Very recently in February, we were rated A- by CRISIL. Back in November, we were rated A- by India Ratings. Both of these, I would encourage you to read the rating rationale of CRISIL, which is more recent. Would give you a sense of the prudency we have followed as a company in managing risk. It is also an indicator that with time our cost of funds will become more efficient, and as we become more efficient on the cost of fund side, we are able to cater to a larger segment of the market, which today perhaps we are not able to cater to because of pricing reasons. This is the technology backbone. I think Dinesh already mentioned. It's a fully cloud-hosted platform with zero fixed servers. The architecture uses what is called as a microservices architecture. The microservices architecture helps you evolve, modulate, build systems on top of each other much faster. We are talking about 4 systems which are entirely built in-house. No reliance on external people. These are lead management systems, lead generation systems, credit products, loan origination system, loan management system, and of course the automated collection system. The system is so modular that for us to plug channels in the front end is simply a plug and play, which when I talked about digital marketing or small merchants or large e-commerce players, it's just a plug and play in terms of just adapting a new channel on the front, as well as given the partnership business, working with multiple vendors, so the loan management system actually helps you integrate very, very seamlessly. So this entire platform helps you scale faster and more robustly, which is very different from a very traditional way where you think about branches. So every scale up requires much advanced planning. For us, scale up is a function of 2 things. One, whether there is a demand out there, and whether the market climate is supportive from a credit risk standpoint, right? But otherwise, the infrastructure itself never comes in the way of scaling up for us. A quick overview of the team. There are 2 founders, me and Ranveer Singh, the CEO and the CFO of the company. Both of us come with extensive financial services experience. Both of us were part of McKinsey & Company for a long period. That's where we met each other. And I think there's a shared belief that technology and digital, both of us are strong in it, has the potential to create a disruption in the credit market, and that's what led us to the journey we are in. Just adding 2 more people who are very core to the team. One is Neha Shimran, she is the Chief Data and Analytics Officer. Comes with impeccable data background, working in global institutions like Lendo, Transfield, Civil, and State Bank of India. And Sandeep Kadar, who is the Chief Technology Officer, again has worked in multiple leading fintech and consumer tech companies. In terms of strategy going forward, I would say it's a very 3-pronged approach. I think the number one important factor for us, which is what we have been always doing, is to focus on our segment, which is a mass market segment, and try and achieve a leadership position on that. And what that means is, I started 8-9 years back with this segment in personal loan. 2 years back, I started loan against property. As I think about a leadership position in the mass market segment, we would think about what other products can we cater to this segment, so that we are able to more holistically serve the needs that they have. That's number one. I think number 2 is, credit model is not a very static thing, it's a very living thing. So continue to improve the underwriting models, continue to deliver on execution in terms of prudent risk management will be the second facet of what we do. Last but not the least, I think we live in a world of Gen AI, which is already causing and which probably will cause even more disruption. So to be open to that in terms of adopting it in a way that helps us from business point perspective is the third facet where our strategy will really be focused on adopting some of these latest techniques. Just some reiteration of numbers. We grew at 80% CAGR between FY23 and 25, and if you actually see the 25 to 9 month 26 and extrapolated, very similar growth rate, I think it's close to about 60%. Even as we speak, the debt to equity ratio is a very healthy number of 1.63 as on December. As I mentioned before, with the capital adequacy of 26 odd percent, which is much higher than the regulatory requirement of 15%. Continued improvement in risk cost, and last but not the least, at 100% CAGR in terms of PBT. Our comparison of some of these numbers with our peers, of course, 80% growth in AUM is something that we are really proud of, particularly given that we've been able to deliver on the profitability and improve risk as well. 4.8% ROA, again, some of the best in class. Of course, both there are some unlisted peers we mentioned here and some listed peers that are open market, public market. I think these are just a reiteration of some of those metrics. Thank you very much, and happy to take any questions.
I have a few questions. One is, what should be your share in digital lending in India? Do I ask you questions first, or one by?
Either way is fine. You can ask all the questions.
And my second question is, what is the APR like in rate of interest, processing fee? Isn't it slightly higher than the physical lending process? Also, what is your user base, and how do you take care of the data privacy and confidentiality, safety of the data? And my last question is, what is the ticket size of each loan? What is the profile of your customer, general profile? What are they using this loan for? Are the sapnas becoming too heavy for them, or what is the picture? And what is the default rate?
Okay, let me address the first question. See, from a digital lending share perspective, it's the number that I will struggle to give, to be very honest. As I said, our AUM is 5,956 crore, and if I can just compare to one of the largest players in the market, say a Bajaj, which is let's say 4 lakh crore, some part of that will be digital lending. So to get that number accurately for all large players as well as for all the unlisted players is going to be very difficult. Needless to say, it's a number which will not be significant, and therefore just avoid as a great opportunity to grow. I would say more than share of digital lending, the way we see it from a growth opportunity standpoint, the shift from traditional way of lending to the digital way of lending, and that shift is quite real. I think that's what we shared in the industry report in the RFP, and that shift for companies like us, which are built on digital backbone, will just make it easier to adapt and address the opportunity than say a very traditional approach. But to give a number on market share is very difficult for us. I think the second question that you asked is on the yield and APR side. I think some of the numbers are there in the RHP. Our average yield is close to about 30%, 31%. I won't get into the subjective discussion on high or low. I will leave that discussion, leave that judgment to you. I think the way we look at it, number one, we have to be fully compliant, and that is something we do. We are a regulated body. Our NBFCs, our partners are regulated. So we work within the realm of what is allowed under regulation. I think the other way we look at it, so if I see from a customer perspective, if it is high or low, see, we are a branch-less company, we don't have a salesperson. You may be receiving, we all receive thousands of calls, we are available there. Our customers don't receive anything. Not a single outgoing call goes from our company. So if they accept us, they see a value proposition, and the way at least we've been able to address it, why he still takes us. See, the average tenure of a loan, I think, to answer some of the digital questions, is 13 months. For a smaller ticket size loan, say 30,000 rupees of that kind of ticket size, just mathematically speaking, the difference between, say, if I give a loan at 30%, say, and give it at 22%, just hypothetically speaking, if you just do the math, the EMI quantum will be 100 rupees or 200 rupees more. So the quantum is less, right? So while mathematically the yield looks larger, the absolute payout, that to spread over say 12-13 months, makes it reasonable, and it's something they find it worthwhile from our customer survey than going to a branch, talking, wasting a few days, etc., etc. But that's just, I'm talking from a customer perspective. I won't get into the way we think about it. See, our endeavor is to continue to reduce the rates. The RFP mentioned some numbers before and later. We are some of our strategy going forward is to improve cost of funding. The A minus will help. We talk about how do I leverage, how do I operationally leverage the large indirect cost that I'm carrying today, with scale that will come. So it's a journey for us, and that journey will continue to do that. But from a customer standpoint, the proposition is convenient, and for a smaller ticket size, is willing to pay that price for the sake of convenience. That's the second question. I think third question is user base. I already mentioned it's 11 million of the customers we serve. 11 million. If I talk about the total user base, also mentioned in the RFP, it's 63 million. So that's a unique user base that we're talking about. And from a profile perspective, I need to go back to that page again. At the bottom, you see are the use cases, right? So 47% of the use cases are actually for business purposes. They are typically small ticket size working capital needs. If you are a small business owner, your inventory may be having maybe a 1 lakh inventory. You want to top it up with a 20,000-30,000 inventory. That's what we would use it. 29% is actually consumption. These are your standard consumption. It could be mobile, CD, whatever the standard consumption. Also services consumption, right? Travel or whatever. And 13.46 are what we call as consumption, which is defined as typically education or medical reasons. So this is the use case. To answer your question, are we the last resort kind of thing? The answer is no. But the biggest estimate of that man is that the average CIBIL score of our customers is 7.6. So these are customers who are otherwise credit worthy. So they genuinely see a value proposition with us, and that's why they come to us. I think there was one more question on data.
Data, yes.
Yeah. I'll be very honest, it's one of the topics that as an organization keeps us awake. We do manage a lot of the customer data. Before I talk about what we do, let me again say there are two, or rather, there has always been a regulation, but with DPDP Act and the digital lending guidelines that RBI first issued 3 years back, there are significantly high levels of safeguard that the regulator has put in and the government of India has put in. We are entirely compliant on that. But I think it goes beyond compliance. I think it's not a letter of compliance, it's also the spirit. There's a constant endeavor to ensure robustness of our infrastructure. I can separately take you through what are the steps we take. I don't think I can, there are a lot of them not public, but I can separately discuss with you, all the anti-hacking, etc., all the steps we take. But it is definitely a very, very important focus for the company. In fact, among the large technology team that we carry, there's a significant part of that team which is focused entirely on technology security.
Just to add, all the data that we capture as part of the application process is entirely consent-driven architecture. So the customer is fully aware of what data we will use, at the time of underwriting when we are approving the loan.
Under the new act, you are supposed to do that.
Yes,
we are always supposed to do under the new DPDP Act.
But the only thing I will say is the digital lending guideline of RBI preceded DPDP Act.
Even that.
And many of the steps are already applicable to us even before this act came into the picture.
Thank you for attending this session. So your participation has tremendous value, and we are grateful for your engagement. To summarize to reiterate the recontours, issue opens on April 30th, issue closes on May 5th. Issue is aggregating to 926 crores, including 850 crores of fresh issue. The price band is 160 to 171 for equity share.